Hi, this is Daniel Scrivner here with a quick preview of our next 20-minute playbook episode, which comes out tomorrow. In it, I'm joined by serial entrepreneur Justin Mayers. Justin is the founder of a number of companies, including bone broth maker Kettle Fire, America's #1 keto brand Perfect Keto, and the non-alcoholic wine brand Shirley Wines. Each of these companies alone does tens of millions of dollars in revenue each year. And on top of that, Justin is also a venture partner at Long Journey Ventures. This is an incredible conversation you won't want to miss. Here's one of my favorite moments from it. Tune in tomorrow to listen to the full episode. You've also raised, more than 20 million in venture capital for Kettle Fire. You're a venture partner at Long Journey Ventures, and you're an active angel investor now. You've got a syndicate on AngelList, and you're thinking about doing more there. What are some of the biggest lessons you've learned as an investor, and what have been some of the biggest surprises, positive or negative?
I think that Peter Thiel talks a lot about there's this whole thing of being a contrarian investor, which I think one is useful, but I think secondly, you really have to be contrarian and right. And if I look at my best investments, investing I think is all about finding assets that are basically mispriced or that you think, are cheap now and will be more expensive in the future. I think that people are really good at pricing things that are easy to understand or that are kind of obvious. And you see that in, early stage SaaS valuations being high the last couple of years. You can now get debt and borrow against, you can basically get debt to acquire a company, because you can underwrite SaaS assets, you can underwrite e-commerce, you can underwrite all these things, which means valuations are pretty reasonable. And even if you hit a great win, invest in a SaaS company at a 20 million valuation, they sell for 100. It's you took on a lot of risk and you got a 5x. I think that the thing that I kind of look for pretty systematically at this point, I would say, and I've learned a lot from the team at Long Journey about this. This is not a Justin original at all. Those people are much, much better investors than I am. But I think that the thing that I've learned to appreciate is that people will systematically undervalue and write off things that are super weird or they don't understand. And if you can basically look at something that everyone says is really weird and actually tell yourself or figure out oh, I think that, yes, this is weird, but I think there's a small chance that X, Y, and Z works. I think that's probably how you become a good investor. I think that this applies to trading. I think this applies to a lot of stuff, but early in COVID, for example, I basically in end of January, early February of 2020, I was seeing people start to talk about COVID, and I was okay, I think that this is people are probably giving this a 1% chance that this becomes a big deal. I think the probability is probably closer to 10 to 20%. And so I sold all of my stocks basically in February 2020. I should have bought puts, but got lazy and I didn't, which was really dumb. But anyway, basically sold all my stocks when the market crashed. I was great, that was a good decision. But on the off chance that I was wrong, I could have just bought back in April and would have been fine. And so I think that thinking about where do you have a sense for, the world thinks that X is a probability of 10%. You think it's closer to 30 or 40. I think that those are the types of bets that are really interesting to make, where you can predict a future or see a future where if X works, it would be huge. And I think that X has a higher chance of working than the average person, and that things that are weird enough but where you have a thesis on why the rest of the world thinks this is not probable, but you think it's slightly less improbable, I think are the best types of investments to make. That was a lot of word sauce.
No. I think it's a difficult point to make because it's very nuanced. I think you did a great job, especially in kind of identifying the framework. The only thing I was going to add to that is I've noticed this a lot in venture capital. So you and I both have done some, investing in venture capital. One of the things that always boggles my mind is you kind of understand that you're making your job, if you're doing it right, is to make kind of long odds bets that if you're right, it performs really, really well. And yet the number of people I come across that try to look for deals that make sense, meaning you're in venture, you're trying to bet on things that if they were to work would be massively successful. But instead people try to bet on stuff that absolutely will work, which just means the return profile is really, really, really low. And it's amazing to me. I just come across this all the time and it just continues to blow my mind. I think it says a lot about human psychology and fear.
Oh, 100%. I mean, I completely. I also think that, to be on the other side of that, not really, but slightly, is there are a lot of horrible ideas out there that don't make sense. And so like there's this weird like needle that you have to thread where you're like, I think this is, like as someone who does angel investing and is now involved in venture, it's like we see a lot of what I would just say like things that we don't think make any sense at all. And our job is basically to look at 100 deals, 98 of which don't make sense, and choose the one or two that make sense, but that everyone else around us also doesn't think makes any sense. It's like a very weird, and then we're often wrong. And it's just like a very weird thing.
Yeah. I mean, if there's anything you learn from venture, I feel like it's a lot of intellectual humility because it's like being in the boxing ring.